Hi, everyone. Welcome to our webinar. Thanks so much for joining us today. My name is Colleen Quattlebaum, and I'm the head of marketing at ConnectBooks. And we're excited to have you here for today's webinar. The topic is From Inventory to Insights, how better cost data leads to better decisions. So whether you're selling on Amazon or Shopify or Walmart or across multiple marketplaces, one thing is true for every e-commerce business, and that is that revenue is only part of the story. So understanding your true profitability starts with having accurate inventory cost data. And today we're going to explore why so many sellers struggle to get a clear picture of their margins, how inventory and finance often operate in separate silos, and what growing brands can do to connect those pieces and make more confident business decisions. So I'm excited to have two amazing founders here with us today to have a great conversation. These gentlemen have spent years helping e-commerce businesses solve these challenges from different perspectives. So joining us today, we have Nachman Lieser, the founder and CEO of ConnectBooks, and he helps thousands of e-commerce sellers to simplify their accounting and really gain deeper visibility into their true profitability. And Jagat is here from Ordoro. He's the founder and CEO, and his team helps e-commerce businesses to streamline inventory management, shipping, and fulfillment processes. So today we'll spend about 30 minutes hearing insights and asking these gentlemen questions to get helpful tips and pointers that can really help you hopefully walk away with some practical ideas that you can apply to your business right away. Feel free to ask questions throughout the webinar. We do have a Q&A or a chat at the bottom, so pop any questions in there. And we are recording this and we'll send it out over email afterwards in case you missed anything or want to share it. But for now, I will go ahead and just close out my screen so we can just hop right in to some questions. Right. So, all right. So jumping right in, let's maybe Nachman, this one's for you. What's changed over the last few years that's really made profitability harder than ever for e-commerce sellers to understand?
Yeah, so first of all, Colleen, thank you for putting together the webinar and thanks for getting everything together. And Jagat, thanks so much for joining us. So in terms of what has changed a lot recently, which is actually a very interesting fact that I've seen recently, is that Amazon sales is actually up, meaning Amazon's a public company, so you could see their sales. So real questions everybody asks, like, could you still make money on Amazon? Are things still moving the right way? The way I see it is that e-commerce is here to stay, and e-commerce is just growing. Yeah, you don't have that COVID boom that we had, but e-commerce in general is going up and up. And same way as Amazon sales going up, Walmart sales going up, everything is going up. Now, the question really is what really changed? There's a lot of different factors. One thing that people don't really want to hear is the economy changed. I don't just think it's e-commerce. Construction is also slow. Real estate is also slow. There's a lot of different industries that are slow, not just e-commerce. So the economy did take a little bit of a hit, but I do think at this point the economy is moving its way back up. Meaning, I definitely feel like we already hit the lowest point. But the other question really is, and really what I have seen over the last few years going through so much turmoil, is that the companies that had a solid grip on their numbers, those were the companies that are able to survive. And the reason is that when you know your numbers cold, you're always able to make the right decisions faster. Basically, if you look at 1 month, you see, hey, we didn't make the money we were supposed to make. And the answer is whether it was tariffs, whether Amazon fees going up, or whether shipping rates are going up, or whatever the issue is. But if you have your numbers right away by the 5th or the 10th of the month for the previous month, and those numbers are actual true numbers, not just like made up numbers, you can right away pull the proper levers. And usually you should have the proper KPIs in your business to understand which levers you want to pull. If you don't have your proper numbers the right way, and everything you do is based off feelings and emotions, then depends on your mood. If you're in a happy mood and you think things are going the right way, then the business moves that way. I just hung up the phone with somebody earlier today, and his books was completely in a mess. He's like, "Yeah, we have a bookkeeper, we do it this." I was like, "Look," I said, "you don't have the data, and you know what happens when you don't have the data? You're making decisions based on your emotions." I said, "You don't know in reality where things are moving." So that's really what I was seeing. I've seen is that what and I can say is every big seller, I haven't come across a big seller that does not have a proper set of books and does not have the numbers like clearly lined up, ducked up, where they can see exactly every month. What is our break-even point? Like I once spoke to a seller that was selling a product. They made on that product $10,000 in 1 month. Like, and I told them they didn't make money. Like, what do you mean? We made $10,000. I explained to them that if you understand how much your overhead cost you, and if you take that and factor it into your margin, you got to be hitting at least a 15 to 70% margin in order to make a profit. You're at a 10,000, it was like around maybe a 10% or like somewhere around there. And I said, that's not enough to cover your overhead. So maybe you're looking at your profitability analytics and you see, oh, wow, this product made 10,000 after all the fees. We're really losing money. So the idea really is to have a real solid grip, real strong understanding of your numbers. So when turmoil hits, which inevitably it will, and there's been a lot of turmoil in the last year, and probably anticipate some more in the next 2 years. But you want to be able to pull the levers the right way. You want to be able to understand which levers you got to pull, and you want to be able to understand where you're going. And what I have seen, the bigger are getting bigger. We do see that because a lot of smaller sellers are falling out, but the bigger ones we do see are moving their way up. And one of the primary reasons is that they constantly know which levers to pull, and they know how to cut the losses short, and they know how to just move on.
So speaking of KPIs, what's a financial metric that e-commerce sellers think that they understand or think that they know, but they often get wrong? Like, are there blind spots that are commonly overlooked? Like, what metric or KPI do you think that they're missing out on a lot of times?
I'll jump in first. Jacket, I hope I don't go too much over time. But the thing that I actually the reason is I mean I love KPIs, and I would say is that there's a few different KPIs to look at. The challenge is, and this actually goes back to a conversation I had with somebody earlier today, was sometimes people, decide that they understand what the KPI is, and they just look at one little KPI instead of looking at the broader picture as a whole. So let's look at an example. For example, the earlier story we said, somebody makes 10% margin on a product, and they're looking, okay, this product is doing fine. No, the product is not doing fine. So the first thing is to understand what's your break-even point. Break-even point means to say that, and now this depends. If you're just running an Amazon business out of your basement and you don't have no employees, then I mean everybody has some sort of expenses. But depending on how big your overhead is. So what you want to understand is like, at what point, how much sales do I have to do to break even? How much sales do I have to do to make 20,000 profit, 50,000 profit, 100,000 profit? That's the first KPI you want to know. And the only way you're going to know that is by having a proper set of books. The idea of having a proper set of books is that when you use something like QuickBooks, which basically every dollar that comes in and out of the bank account gets properly logged and recorded in QuickBooks. So when that number is there correctly, you can understand how much money you have a clear visibility of how much you're making. Meaning sometimes I meet people that use Excel. She's like, yeah, we use Excel. The problem with Excel is that Excel doesn't match your bank. That's a problem. And the mechanics of getting Excel to match your bank is very hard to build. So the idea is that's why we use a software like QuickBooks, or you can use other accounting tools like Xero, which they match the bank account, and that gives you your first KPI. So I'd say first KPI is understanding your break-even point. Once you understand your break-even point, then you could start to look back at your profitability analytics by SKU and understand, okay, are these products not just profitable, but are they in my break-even point? Like, am I making enough money to cover my overhead and to cover everything else? And then the second metric is really more for Jagged, is really understanding your inventory. So besides making money, is you want to make sure, number one, you have enough inventory, you're not overstocking, understocking, and you're not also having too much inventory that's laying too long. So I always tell people, when it comes to a P&L, a P&L only shows you, like when you look at a profitability analytics by SKU, it only shows you how much money you're making based on products that sold. But what happens with products that never sold? That's something you want to take into account. So you really have to have like a good inventory platform that really gives you true inventory numbers, because what ends up happening is that a lot of times you could be making a lot of money on your products, but you're basically burying it in your inventory. So you want to make sure that you have clear inventory numbers, that you understand how much your inventory value is, and you want to make sure the inventory value is not going out of whack. For example, if at the beginning of the year you have $1 million, You don't want to find yourself at the end of the year with 2 million. You want to find yourself at the end of the year with 1 million as well.
Yeah, just to add to that, right? I think Nachman talked about profitability. You need to know it at the product level. And to add to the previous question that you asked, Colleen, if you look at each channel, that itself is complicated. You need to know all the different factors. What are your costs? What's your overhead? Tariffs have made it complicated. Now imagine that you also have to sell across multiple channels. Like one of the big changes in e-commerce, I would say over the last 15 years is that you can no longer just survive by selling on one channel. You need to be present on every channel, like marketplaces, even social selling, like TikTok and all these different opportunities. Maybe 15 years ago, you just had one Shopify store, and that was all you needed. Now you cannot afford by just selling on one place alone, and the reason for that is you need to be present across all the different channels where your customers are looking for the product. And if you're not present on one of the channels, you're basically missing out on that opportunity to present your product. It's kind of like being on the supermarket shelf, right? Amazon's where a lot of people are buying stuff. So if you don't list your product alongside all the other competitions or competitors on Amazon, you're missing out. So now take the complexity of selling on one channel, multiply that by all the different channels that you're selling on. The whole thing is like pretty soon you lose control of what's going on. And if you don't have your numbers right, if you don't have a very good accounting system in place, you don't have an accurate view on what your true costs are, and you don't have a view on like what your true profitability is. So maybe yeah, you can easily figure out what your revenue is, but if you don't understand your true costs, you are not seeing the complete picture. So that's why, like Nachman said, you need to have your books under control, because without that, you don't have an accurate view of like where your business is making money and where you're losing it.
Yeah, and so then from a KPI standpoint, when it comes to inventory, Jagged, what's a metric that every e-commerce operator should be really watching on a weekly basis?
Yeah, I would say there are two main things I would look for. One is the profitability at the product level. You kind of need to know which product is where you're making money and which one you're not making that much money. The second one is your like speed, the velocity, what I call as SKU velocity. What's your fast movers, what's your slow movers, and what's your middle movers? And that's very important because one thing that often people don't understand, and to add to what Nachman said, is maybe you're bringing in a lot of money on some products, but you also need to pay attention to how much cash have you tied up on inventory. Maybe you have a product that you bought in bulk, it's just sitting in your warehouse. That that's basically a cost to your business because that's cash that you have logged in, right? You already spent money on the product. It's not moving, it's sitting in your warehouse, that's costing you money. So understanding product velocity is extremely important because your slow movers can really tie up your cash. So a common thing that people talk about is that you can be reporting a lot of revenue on some of the products, but it turns out that your cash flow is not strong because you've tied up a lot of cash flow in some of the inventory. So I would say per product profitability is one metric, and your SKU velocity is the second metric that you need to pay a lot of attention to.
Okay, thank you. And Nachman, you know, a lot of sellers know their revenue, but not their true profit. What are some warning signs that a seller's reporting or analytics is not really telling the full story?
Oh, that's a good question. What is saying the real challenge? I mean, there's a couple of different ways. The first thing I always ask a person is that when you're not really confident, I mean to say we'll talk of like from a standpoint where let's put the books aside for a minute. Meaning obviously if you have good books, then the reason why I love QuickBooks is that because QuickBooks reconciles to the bank. So they say numbers don't lie. Chase is not gonna change your ending balance at the end of the month if it's not there. So whatever the bank statement says, that's what it is. And sometimes you just gotta live with reality. It's not easy, but that's what it is. So that's the first reason, why it's so important to have a proper set of books. But one of the other problems that we have always is that what I would say is that like a lever where people see themselves, if you either if you can look at your inventory value, I mean, say if you have a proper inventory system set up, even if it's not 100% fully functional, as long as it's like 90% functional, what you want to do is keep logs of your inventory value and making sure that that doesn't go up too high. So like if, for example, if you see in the beginning of the year you have 1 million, unless your sales like significantly like quadruple, like, or even at least double. You don't want to see your inventory value going up more than double, and not even half more. Like, so if you start with $1 million, because what happens with sellers a lot of times is that every time a deal comes in, they don't think about they're going to lose it. All they think about is how much money they'll make. So that's where they jump in it. But a lot of times they can't sell it fast enough, and that becomes an issue. So that's one very strong metric to look at. And another strong metric to look at to really know is if you constantly keep on borrowing more money. Like I once had a challenge with somebody, and they were basically making a lot of money, and they didn't believe me that they made so much money. They made $4 million profit. So they were arguing with me. So I said, okay, let's go back for a second. I said, I can show you how much money you took out of the business, but then I said, did you borrow any new loans this year? And the answer was no, the business had no loans. So I said, the business has no loans. You haven't borrowed any more money. Your inventory value is roughly the same that it was at the end of last year. Then where did this money come from? So that's also one thing where if people constantly see themselves like increasing credit card debt, or like, let's say sometimes a line of credit could be like the worst thing for a company, because when you take that line of credit for, let's say, $500,000 to $1 million, really your business has an issue. You want to take care of the issue. By taking a line of credit, you kind of, okay, now we have money, so now you can sit back and relax. But all of a sudden, 6 months later, you're gonna have the issue. So like if you recently took a line of credit and all of a sudden you're maxed out, then that's also a problem.
Yeah, and I think the good thing about having a really solid accounting system is that it's not like Nachman said, right? It's going to give you an accurate picture. And if you have a good bookkeeping practices, it'll tell you, because it's very easy to just look at your Amazon dashboard or your Shopify dashboard to just purely look at the revenue side of the equation. But if you don't fully understand the cost side of the equation, or what your balance sheet looks like, you're not seeing the complete picture. So that's why it's very important to maintain, particularly as you grow and as your business gets complex, it's very important to have strong bookkeeping practices, have a good accounting system, have a bookkeeper in place who's keeping track of the complete picture of what's happening, including your loans, including your cash that is tied in inventory, all the tariffs, everything, seller fees and everything. Because without that, pretty soon you're not seeing an accurate picture. And I know some people are very comfortable with like cash-based accounting, but accrual-based accounting often tells you what's really going on in your business that sometimes you miss out if you're looking at the bank statements.
Yeah. Yeah. So that kind of leads me to the next question, Nachman. What is the difference between just the basics of bookkeeping or accounting and true financial decision making?
Well, the real basic thing is where a lot of people go wrong. And, let's say you're a plumber, okay? And let's say you do a house call. So I call you, my sink is leaking. I call you to fix my house. You come into my house, charge me $200 to fix the leak, and boom, and you leave. So that's what we call cash basis. Cash basis basically means you get a bunch of service calls on one day. The money comes into the bank. So basically, if the bank fills up, it's good. If the bank doesn't fill up, then you have a problem. So really, those type of businesses, like where we call them more service-based, usually service-based businesses that, can basically run in cash and don't have massive receivables, they usually basically tend to just, look on bank balances. The challenge is when you're an inventory based. Now, e-commerce is inventory based, so it's not just e-commerce, it's any inventory based business, even if you're running a brick and mortar store, right? So let's take, for example, November, okay? You buy $1 million worth of merchandise to sell in December for the season. Now, when you take that money out of your bank account in November, the way you want to record those transactions is you don't want to expense it. It's not really an expense for the business. So what you want to do is that the way you record it is that becomes part of your inventory, which becomes an asset in your books. And then when you sell, and then when the product sells, you take the amount of money the product costed out of inventory and put into cost of goods sold, where you expense it. So the idea is that we don't want to be like the plumber where we run based on cash, because based on cash for an inventory-based business doesn't begin to make sense, because there's many times that you're spending a lot of money and it's not really an expense for the business because you're going to be selling these products over the next couple of months. So what we do is something called accrual-based accounting. Accrual-based accounting is we do it based on events. Events means that when we receive inventory, it doesn't matter when we pay for it. If we receive inventory, our inventory value goes up, it gets recorded as an asset on our balance sheet, and that also increases our liabilities. When we sell the products, we take it out of inventory, we put into cost of goods sold. That's when we, increase in expense. Now, if you give a customer 90-day terms or 60-day terms, that still does not matter to record revenue. Revenue gets recorded based on events, based on where you ship other products. So the real idea is that, and Jag has touched on it a little bit before, is that accrual-based accounting is what every inventory-based business needs, and that's really what you want to focus on. Versus cash basis is more like, I would say, for service-based businesses. The challenge is that a lot of sellers have a very hard time setting up proper accruals because they need proper inventory softwares. They need something like ConnectBooks, which would automate all the accruals for them. So that's how they have clear visibility and they understand the numbers.
Yeah, and I would 100% second that. If you're going to scale on an inventory business, you have to set it up as accrual accounting. Another point I want to add is that to me, accounting system, it is absolutely necessary, right? You have to do this and you need to have good bookkeeping, and every month, at least on a monthly basis, you need to know how accurate your books are. But going back to your question, Colleen, about like what's the difference between a good accounting practice and a good financial decision-making practice, I would say accounting is usually about looking into the past and seeing where you are and then how you reach there. And financial decision making is about where you're going in the future, right? You need strong books to clearly know where you are and what you have, what your capacity is. But financial decision making is usually about making bets. Like, let's say you know that, okay, I have this product that's selling really strong, right? And maybe you know that you're going to invest heavily in marketing and you anticipate that you're going to be able to 2x that, the sales of that. So that part of making that bet and deciding that you're going to make an investment on the marketing side, or deciding that you're going to buy more inventory for that product because you firmly believe that you're going to sell more of it. That's the financial decision making process. That to me comes secondary in the sense that that's still a very important part of the business. But if you don't have strong bookkeeping and strong accounting, your financial decision making is going to be completely broken. So to me, the prerequisite for everything is like you need to have your books right. You need to use good inventory software that can keep track of what's happening. You need to have good accounting software that can tell you the truth of what's happening. And then you build your financial decision making on top of that single source of truth. So
Yeah.
these are two different aspects of it, but you need to have the first one right in order for you to build a strong decision making process for the second one.
Yeah, that makes sense. Yeah, the accounting is the facts, the historical facts, and the
Yeah,
versus a more strategic, forward-looking
exactly.
decisions.
Yeah.
And so, Jag, you mentioned that like what's changed in the industry. Obviously, sellers, really should be diversifying and being on multiple marketplaces, but that can certainly present a lot of challenges. What mistakes do sellers make when they're managing inventory across multiple marketplaces or channels?
Yeah, there are a few different things that I see. First one is that they need to, even though these are different, every marketplace and channel has its own characteristic. Like Shopify is like it's promoting your own brand. They don't take seller fees. The cost structure is different. Whereas if you're selling on like Amazon or any of the other, or TikTok, there are seller fees. So even though you need to kind of understand that each channel has its own characteristic, but ultimately it's all part of the same. You need to treat it as part of the single business. It's almost like you have different storefronts in different states and there are different characteristics. So you need to understand that. So you need to not treat them as like different businesses. You need to treat them as like a single entity. As part of that, you need to have one source of truth. So when it comes to your books, you can have separate lines for the sales coming from each channel, but ultimately they all should tie into the same inventory, into the same cost structure. Maybe you're shipping it all out of the same warehouses, so you need to have treat it as like one source of truth. But at the same time, you need to know what the cost structure is on each channel. Like you need to know what the Amazon seller fees is for a product, what's the margin there compared to like selling the same product on Shopify, where your margin will be different because your cost structure is different. So that's one thing that I see. The second thing is where we normally come in is most of our customers, Ordoro customers, are multi-channel. They're selling on Shopify, they're selling on Amazon. One common thing that I see is like keeping the inventory levels in sync. So Amazon needs to know how much do you have in stock. Shopify needs to know how much you have in stock, right? If you're selling the same product across these channels, when you sell, let's say 10 units on Shopify, you need to automatically notify Amazon that you have 10 units less in stock. So our software, one of the biggest value adds of inventory sync across multi-channels is that we are constantly listening to what's happening on Shopify and on Amazon on every channel. When you sell 10 units on Shopify, we'll automatically go reduce the stock level on Amazon, and we can now Amazon has an accurate inventory picture. If you don't have that, the situation you run into is Amazon inventory is incorrect, and let's say Amazon took a lot of orders and you don't have enough inventory to ship, you're going to get penalty. Amazon is going to penalize you because you took an order which you don't have inventory to ship out. So keeping inventory in sync is very important. Also aggregating all your order information into one place. So you have a unified dashboard, you have a unified view of the truth. That'll also help you make sure that you're shipping it out on time, prioritizing it, aggregating all your information across your carriers like FedEx, UPS, USPS, all of that's very important. So it's very important to like, it is a single business, so there is one view of truth. You need to have your inventory in sync, but at the same time, you also need to factor in that the fees and the cost structure across every channel is different. So kind of understanding both sides of the equation and balancing that, I would say is the most important piece that sellers need to understand.
Okay, great. That's very helpful. And we talked a little bit about, the impact that inventory costs have when it comes to cash flow being tied up. But what other inventory costs have an impact on your profitability reporting?
So yeah, I can start with this. When you look at the true cost of inventory, there are a lot of different things you need to factor in. You need to factor in obviously, like let's say I'm selling something for like $50, right? And you know that you got that the supplier is selling that to you for $20. It's very easy to think that okay, the profit per unit there is $30, but there are a lot of other factors that can mess it up. You need to obviously factor in the total landed cost, like things like tariffs and what did you pay for shipping in order to receive it. Maybe you have storage costs, you need to factor all those in. On when you're shipping it out, you need to factor in things like how much did it cost for you to pick and pack that product, right? How much did it cost for you to actually ship it out? What was the true shipping cost? How much did you pay for FedEx to ship that out? So those are all the obvious things. The second thing that you need to factor in is that inventory cost itself is never static. It changes over time. So let's say 2 months ago, or let's say, I mean, tariffs, everything that happened over last year is a great example. You had inventory sitting in your warehouse and you bought that at like $20 per piece. But because of tariffs or because of like supply chain costs, you're buying a lot more units of that. Now you're getting the same product at like $40 a piece, right? Inside your warehouse, you have some old inventory, you have some new inventory, and when you blend that, the total cost is changing. So inventory cost itself is not a static entity. From an accounting side, there are different ways people measure this. People often use like FIFO, which is first in, first out. You can say that when I ship out the orders, I'm pulling in the oldest inventory. Therefore, the cost that I'm going to associate is the $20. Or you can have like LIFO. I can say like, no, I'm going to, whatever I received last is what I'm going to ship out. So the cost basis is $40. Or you can have like a blended cost, which is a weighted average cost, which is what like a lot of inventory systems do, including ours, where you can say, yeah, I have old inventory at $20, I have new inventory at $40, but based on the weighted average, maybe it's $35 is a blended average based on how much you have in stock. So now that becomes your cost basis. And just to add to what Natman said, if you're doing true accrual accounting, when you're expensing that, you need to know exactly what is the cost basis you're going to choose for that shipment that's going out. So when it comes to inventory itself, like there are a lot of different factors that you need to look at in order to understand what exactly your true cost is and not just the cost that's written on the PO that you sent to the supplier.
And
One thing
oh yeah, go ahead.
I would just like to add on one thing is that, there's a lot of different analytics tools and profitability tools which make it easy to like something like ConnectBooks, which makes it super easy to see the profitability by SKU and then, see, okay, this were my sales, these were my fees, this is my ad spend, and this is my profit. The challenge that most people face above that is that what Jagat's meant before is having the true cost. So depending on which valuation method you use, if it's going to be FIFO or moving average, we prefer FIFO. But on the other thing is we also want to make sure it's very important is landed cost. So that's usually I find the hardest thing to do is because as Jagat mentioned, inventory is never static. So let's say you buy something for $20. The question is how much money did that cost you to import and what did that cost you in tariffs? And you want to take that money and allocate it to the product. The challenge, the fees, like the fees that the marketplace charge, I find that data points easier to aggregate and to get more. What I find the hardest that people have the hardest time is really landed cost and really understanding the true cost of a product, because that's something that it's more on the business owner or the bookkeeper, whoever is handling it, to put together this data points. It's not something that you can try to use a tool, but somebody got to pull together all the shipments, all the product costs, do that. Now, the reason why I'm stressing so much on this is that because we have worked with clients who thought they were making money on certain products, meaning after Amazon fees or Shopify, or whatever it was, whether Google ads or even after all the TikTok fees and even after TikTok ads, they thought they were making money. And then after we ended up setting up landed costs for them, which we basically allocated the shipping cost and the duties to the product, they actually realized that they're not making money. So that's like something that it requires some manual work, but it's super important to do.
Yeah, and obviously, ConnectBooks is an accounting software tool. Jagus or Ordoro is inventory software, and there was a problem in the market that was identified that led to an integration between our tools. So, do one of you want to talk about like what the problem was? There was a customer who specifically asked for this, and there's a need in the market to connect our inventory cost data to fully understand profitability. So do you want to identify the problem that arose in the market that led to our integration?
Yeah, so I mean, the main thing really is that we focus a lot on automation, right? So the goal is that you want to have proper automation because you don't want to be spending 30, 40 hours a month crunching the numbers and spending a lot of time. So what happened is we were working with certain customers that were using Ordo, and ConnectBooks is basically pulling information from Amazon, Shopify, and the other marketplaces that customers were selling on. But then the challenge was, taking the data from the marketplaces and then getting the data from Ordo and combining all that it took quite a lot of time. And at some point, the bookkeepers were just not getting to it. So one of the things we've done is built an automation where basically if you're either using Ordoro or ConnectBooks, and the integration was built by ConnectBooks. So once you have a ConnectBooks account, basically you connect it directly to Ordoro. And the nice thing about the integration, which I love a lot, it's a plug and play. Meaning to say, meaning once you have Ordoro set up and you have your inventory properly set up, ConnectBooks takes like 5 minutes. You create an account, you connect it to Amazon or Shopify or TikTok, the data loads into our system. From there, you just connect it to Ordoro. And the way we do it is we just match up the SKUs. So that's how we automatically pull in the proper cost and we have the proper information. So literally for anybody who's already using Ordoro and looking to gain clarity in their books, we have a solution that takes you 5 minutes. And once that's set up, you just gotta then start hooking up ConnectBooks to QuickBooks, which is like a 10-15 minute process, and then you'll be able to see your numbers.
Yeah, to add to that, I think to me this is like a natural fit. The way I think about this is that just going back to what I was saying earlier about having a single source of truth, right? You need to know exactly what's happening in your business across the board. So the inventory systems will tell you a lot of information about like what's your cost of inventory, how fast are things moving, a lot of stuff around like even like in our case, we also show you the shipping costs, what came in and what went out. So there's a lot of information in our system. But there's also a piece of information that we don't keep track of, right? Things outside of inventory. For example, what your warehouse rent was or what your salary for your pick packing employees were. We don't keep track of it because that's kind of outside of the inventory. And that's where an accounting system comes in. So these two systems are giving you a lot of different pieces of information that you need. It's almost like you're flying a plane and you have like different instruments that are showing you different pieces of data. They need to function together, right? If they're not functioning together, you're not seeing the complete accurate picture. So what this integration does is it's really tying different pieces of data from two different points of view. From the bookkeeper's point of view, everything is there in your accounting system, and from the inventory manager's point of view, everything is there in like an inventory system. Tying these two pieces together is very, very important. And from my experience, what I've seen, I speak to a lot of small to medium-sized business owners. These two systems functioning together is extremely important for you to have the complete, accurate picture of how your business is running, and therefore you can make the right financial decisions based on it. If you don't have the accurate picture, you're kind of making decisions based on incorrect data, and then that's not good for you as a business owner.
Right. And so many sellers do have separate accounting and inventory systems, and they're living in two separate worlds as two separate silos. And so by combining all of this data and syncing it, then you can really drill down to your true profitability by SKU, see your cost of goods sold. But Nachman, what about historical cost tracking? Why is that important as well?
What do you mean by historical? Like keeping, what do you mean by
Right.
me?
So yeah, why is historical cost tracking important to get true, accurate reporting?
Meaning,
I,
I'm assuming by historical is to kind of keep track of the historic data. I mean to say that the cost constantly changes. So when the cost constantly changes, like for example, you want to know like what the cost is up today. So let's say, for example, if you start January, the cost is $5, then it goes down to 4, then it goes up to 6, then it goes down to 8. So you want to really keep track of it. And you also, one important aspect is that when you run a profit and loss, you want to be able to compare. So like, for example, what I always tell people, like we have something called a comparison P&L. And I always tell somebody, you don't know what bad is until you see what good is. Meaning, if you make 1 month 50,000 profit, who said that's good? Maybe really you can make 200. Now, the answer is really that you want to take like one good month, your best month, and you want to use it like as a benchmark, and you want to benchmark against it each month to make sure that you get your maximized results. So the challenge is like if you keep a very static cost and you constantly change the cost of products and you don't have a proper inventory tracking system, then when you look back at that previous month, all of a sudden your numbers are out of whack. Like, oh, really? Instead of showing you made that month 200, might show 250 or 150 because costs constantly change. So you want to really keep your historical data properly so you could constantly benchmark.
Right. And that kind of goes back to Jagat's example earlier about buying an item at $20 in a little while, buying it $40 later. So making sure that that's all synced with your accounting system and your inventory system. And what kind of decisions become easier? We talked about how accounting is different from true financial decision making. So by syncing these two tools and having this integration, what kinds of decisions become easier when it comes to inventory or profit, related decisions?
yeah, for me, I again just going back to the idea of per product profitability, that usually you need to have the complete picture to answer that because it's not just enough to see how many orders came in and how much people bought it for and the seller fees. You need to know your complete picture, including your like maybe let's take an example. Let's say that you took a loan of $1 million to buy up a lot of inventory, right? And let's say that you're paying like 5% interest rate on that loan. If your product is not moving, there's an interest cost, which is basically cost. It is triggered by the fact that you have so much inventory sitting in there, right? Your inventory system may not really tell you that because the inventory system doesn't know that you're paying like 5% interest rate on that loan. But your accounting system is going to tell you accurately that it'll show you what your interest costs are. So by combining these two pieces of information, it's really like if you want to make financial decisions, you need to understand the complete picture of what's happening in your business. So to me, having an accounting system that tracks every single thing that's happening, marry that with truly what's happening in your warehouse, what's coming in, what's going out, and what the total costs are. That's very important because without that, you're only seeing like one side of the story, and you're not making the right decision. So in that case, for example, maybe the right decision would be that okay, this product is not moving fast enough and you're paying a 5% cost every day it's sitting there. So maybe the idea is that okay, you need to just get it rid of the shelf. So maybe you need to sell it at a discount then and get all that cash freed up so that you can invest that cash in like some other area of the business. So it may not be very obvious if you don't understand the fact that, and I've seen some small business owners run into this trap. I remember talking to there was a company that we had worked with very early on. They had bought this business owner had like taken credit card debt and bought up a lot of product which was extremely slow moving. He did that because he got a discount on that product, but in the end it turned out that it was not worth buying all of that product, even though he got a discount because the amount of the interest costs that he was paying on that was like not worth the discount. So that's an example where like marrying accounting with inventory management will give you the right picture of what's going on and help you make the right financial decisions.
Great. Anything else that you guys want to add related to inventory profitability or this integration?
I'd say if you get it together, keep the right levers. They say cash is king. You'll have a lot of money in the bank.
Exactly, yeah. And then, yeah, this integration is something, if you're an SMB business owner, you should absolutely take a look at it. Like Nachman said, it's plug and play. Ordoro focuses on the shipping and the inventory management side of it, and ConnectBooks focuses heavily on the accounting side of it, including all like marketplace fees and everything. It's very easy to try it out. So yeah, you should give it a shot.
Yeah, great. Yeah, and again, feel free to ask any questions. You can also email us directly. Nachman's email is nleaser@connectbooks.com, as you can see here on the screen. And as a thank you for everybody joining us today, we are offering 50% off of ConnectBooks for the first 2 customers. So if you're interested, please email Nachman, and he'll make sure to have a conversation with you and get you set up. And again, thank you both for your time. But anything else that we want to add before we close out? All right. Well, again, we're excited about this integration. I know JAG has helped so many e-commerce sellers from the inventory side, and ConnectBooks, we've helped a lot from the accounting side. So marrying these 2 together really just makes sense. So looking forward to helping sellers really take their business to the next level by using this integration. So thanks everybody for your time today. And we'll be sure to email the recording to anybody who missed it.
Yeah.
Thanks a lot.
Thank you.
All right. Thank you so much.
Thanks. Bye-bye.